Hello, Theo traders. This is Gianni DePoce, and today is the 12th of December, 2023. And I want to review some charts with you and talk about what's been going on in the financial markets. So we had another CPI report that did not blow out expectations. We had inflation data coming in pretty much what analysts and economists expected it to be. And in response, we saw equities respond largely in a positive manner. But tomorrow we are going into the FOMC rate decision followed by a Powell press conference. So the question on everyone's mind here is, are we sleepwalking into a nasty mean reversal in equity markets? But I want to take a look at it through the context of currencies and other markets that are related to it, and especially take a look at crude oil in this video, because the way it's dropping, in my view, it signals that something bigger is going on behind the scenes. So let's start off by taking a look at USD JPY. In last week's video, we pointed out how it was threatening a potential breakdown from a rounding top formation, and we did get that breakdown lower. Now, the way that stocks have been rallying over the last couple of months, it's been a situation where stocks have been rising as the dollar has pulled back. And so basically that tells us that the rally in the equity market has been one of currency depreciation instead of a result of net global demand for U.S. assets. So, the USD JPY currency pair is definitely in a defensive posturing now, as evidence continues to mount that long-term cycles are rolling over in the Japanese yen. And I think one of the biggest catalysts behind this is that the market is waking up to the likelihood that the Fed will be easing in 2024. So the interest rate differential between dollar assets and yen assets will not be as wide going into next year. Obviously, the rate cuts need to happen first, but we know that the market likes to discount future events. So I think that's a big thing we need to keep on the radar with respect to currency markets. If we go ahead and jump over to the euro, trying to stage a little bit of a rebound here today, but in my view, still in a lower, in a downward trending market. We keep making lower lows and lower highs. You can make an argument that we're trying to make a higher low here today, but obviously we need to actually rally out of that low. So I think we need to be cautious in the currency market, especially going into Powell's press conference tomorrow, the rate decision. We're not looking for the Fed to do anything. The market's not looking for the Fed to do anything. So I often like to say that the day after the Fed meeting or the Fed announcement is more important than the day itself with respect to the market's price action. So I'm not going to put too much stock in what's going on tomorrow, but I'm definitely interested to see how we close out on Thursday and on the week, especially here in the euro, because the long-term trend in the euro is down. Let's go ahead and jump over to bond markets. We'll take a look at ZB first. It's trying to complete a higher low with respect to the trend. It is approaching one of the upside price objectives that we discussed in chat, namely in the 121 to 122 area. And the big question on the mind of the fixed income community is whether we are in a new long-term cycle. And we discussed this at length in chat. So if you want to know more, we'd definitely tell you to tune in and listen to the conversation. But if we're in a new long-term cycle in bonds, we should see the bulls continue to bid this market higher going into 2024. And, that begs the question with respect to the yield curve. How can the Fed re-steepen the yield curve if long-term bonds are rallying so much? Well, the answer would be they're going to have to cut aggressively. So, we are seeing some nice leadership in duration, meaning that long-term bonds are rallying faster than bonds in the middle or on the short end of the curve. And that generally means that the rally in bonds is for real. So that's something to keep in mind. Now, I did mention crude oil at the beginning of this video, and I want to look at it here because this is definitely a tailwind for the bond market to continue higher. And, we discussed some various downside price objectives in chat, but one of the ones that we've been discussing for a couple of weeks is the $68 level, and we are within just a few cents of that. The low today on the 12th of December was 68.22. So we came within, just over 20 cents of that downside target. We have some shorter term cycles that still need to run out to the downside before a more decisive low can be completed, in my view. But we know, based off of the market's price action in the past couple of years, that this probably is a tailwind for stocks to continue higher. And we know it's a tailwind for bonds because if crude oil prices are collapsing, inflation expectations are following it lower. And by extension, we know that interest rates like to follow inflation expectations. So we have a macroeconomic backdrop now that points to lower interest rates due to lower inflation rates. And I think it's going to be bullish for the equity market, and especially tech. So if we go ahead and take a look, speaking of tech, take a look at the Nasdaq. We just rolled over to the March contract this week, and we are close to making a new all-time high. We are not an all-time high yet, but the Dow Jones is within a few hundred points of making an all-time high. And the fact that we could see the Dow break out on a technical basis before the Nasdaq, I think speaks volumes to where we are cyclically with respect to the stock market. But we continue to see the Nasdaq outperform on a percentage basis. So that also is very much a risk on signal. And if we want to, break it down even further within the tech space, we can take a look at the semiconductor sector, which broke to a new high this week as well. And given the nature of this sector, it's known to be a leading indicator, meaning that semiconductors tend to move in a particular direction before the rest of the market. So, and that's even within tech. So tech tends to be a leading indicator, but semiconductors, I think, are even more sensitive to growth sentiments and acting as a leading indicator. So if you're seeing semiconductors break out to new highs, I don't think that would be classified as something as bearish for the overall equity market. So that's something to keep in mind as well. One of the concerns I do want to jump over to the cryptocurrency space, take a look at Bitcoin and Ethereum briefly. We had a nasty down day, limit down on Monday. And, crypto has turned into a really nice barometer for risk appetite that seemingly translates over into the equity market. And so when I see, Bitcoin and Ethereum catching these nasty sell-offs at the beginning of the week, it does raise my eyebrows and put me on alert for a potentially similar situation unfolding in stocks. I mean, let's face it, there's a lot of euphoria now. There's a lot of chasing happening in the equity market, but, that doesn't mean that there aren't favorable risk reward setups. But I do think by and large, the easy money in crypto, especially Bitcoin, has been made. But, we've called out some really nice trades in the chat room for members, namely stocks like MicroStrategy and Coinbase have been big winners in the last couple of months, seeing significant returns in that space. And not to mention, even some of our tech trades like CrowdStrike continues to make new highs recently, and even advanced micro devices. We were just talking about semiconductors. These are all major themes, I think, that need to be focused on going into 2024 with respect to the principle of relative strength. The strong get stronger and the weak get weaker. And, year to date, all of the weakest performing sectors have been defensive ones. Stuff like consumer staples, utilities, those have been the worst performers year to date. And that in of itself is a bullish signal. You want to see the risk on sectors like tech, communication, consumer discretionary. I mean, you look at some of these consumer discretionary names, even a stock like Gap, we were talking about this in chat. It formed a flagpole and we were looking for it to flag, but it just kept going higher. So I think, between crude oil prices being down, consumers have a little bit of extra money in their pocket during this holiday season. We know that the economy is centered around consumption in the United States. It's looking like, bulls have some momentum, but again, going into tomorrow, will Fed Chair Powell throw a wrench into it? I do expect Powell to come off as hawkish. I still think that he's running with that line, and a lot of the other central bankers are as well. But I do think that the new higher for longer is the old transitory inflation. I think the market is right. I believe the market. I don't care what the central bankers have to say. Their track record isn't all that great. So that's where I have us right now. And obviously, we're in a pretty bullish time of the year. You know, we're not quite to the Santa Claus rally period, but December does tend to be, you know, rather optimistic for equity market performance. So that's all I have for now. Looking forward to seeing you guys in the chat room. Thank you for tuning in. Until next time.